We are beginning topic 4. You should have read the introductory information already, and this video will give you an idea of what we will be covering in topic 4 and also in topic 5. And we begin where we've begun before with the accounting cycle. On your screen you see the steps involved. Step 1, a transaction takes place. The business sells something perhaps or buys something. Something happens with the business. So that information is put first of all into a journal, the first book of the business that we will be looking at a lot in topic 4. This process is called journalizing. The journal is a day-by-day chronological record of what happens in that business. And the word journal is kind of self-explanatory. This is a chronological record. Every day things are put in the order that they happen into the journal. So we'll see how that works later. But that's pretty self-explanatory, as I said. The word journal kind of explains to you what this is all about. Day-by-day record. From the journal, the next step is taking the information and putting it into the ledger, the second book of the business. This process is called posting, and we're not going to get into why that word is used, but you'll find in the world of accounting a number of terms are very traditional and are still used based on some unknown, vague reason way back when, but this is one of them. The word posting means taking information from one book and putting it into another book, in this case into the ledger. The ledger is not a day-by-day record, it's rather a book. If it's an actual book, it would be consisting of a number of pages, each page representing what we call an account. Let's take a look at those accounts. If we look at the statements that we've used before, we made balance sheets and income statement. These should be familiar to you. And these over here that I'm highlighting, for example, are called assets, but they are also called accounts. These are asset accounts, and each one of these would have a page in that ledger book. So we keep track of different accounts. In the ledger book, we have a series of pages that would be called liability accounts. There's a page called owner's equity account. There's a page called sales account, and there are several pages called expense accounts. So these are not only assets, liabilities, and so on, but they're also accounts that are found in the ledger book. So it's a series of pages, and we'll show how that works. Of the two books, probably the more important one would be this book, the ledger. It's important to have a day-by-day record of what happened in the business, but this book, the ledger, is probably more important because it gives some very valuable information. So we'll see how that looks in a few minutes. And finally, the last step, the financial statements are made. And these statements could be made at the end of the month, if that's the period, quarter of a year, 6 months, a year. It varies with business to business. So that's the accounting cycle. Now, what we want to do, as I mentioned before, we're working kind of backwards here. The last step is constructing the two financial statements, and we have done that. Now we're going to back up and look at this important book called the ledger. And to do that, we're going to look at some tabs at the bottom. These tabs you see down at the bottom are differentiated by the kinds of accounts they are. They're asset accounts, liability accounts, again coming from the balance sheet, owner's equity account, the revenue and expense accounts, again come from this statement, the income statement. So let's take a look at this tab. And you're looking at something that's new to you, and I want to explain kind of the background of this before we get into the details. This is a representation of the ledger. Again, probably the more important of the two books. But we want to look at how that is set up, first of all, before we go back to the journal. This is a representation of the asset accounts that would be found in the ledger. So each of these would represent a page in the general ledger. And there's an account called cash, one called accounts receivable, and so on. These are all assets representing things that we own. So let's take a look at these accounts. Sometimes these skeletal representations are called T accounts because that's how they're set up. You've got a horizontal line and a vertical line, two sides, and sometimes this skeletal representation is called a T account. But what's important for you to memorize would be some things that you see listed here on the T accounts. For example, there's a left side and there's a right side. And for some reason, again, we use terms that are a little vague, but you simply have to remember because they are used by accountants all the time. There is a side called the left side, which was labeled debit side. This is not debt. This is not D-E-B-T, but D-E-B-I-T. Debit with the I simply means left in the accounting world. Debt is something that we owe, but that is a different word. You have to understand that this word, debit, means left. The other side, the right side, is called the credit side for some reason, but it is. This word credit does not correspond to credit cards. It simply means, in this case, the credit side means the right side. So every one of these asset accounts has a debit side and a credit side. And every time the debit side means left, the credit side means right. Happens every time. Now, the other thing that you need to remember about asset accounts is that the left side, the debit side of every asset account shows increases to that account. The credit side, the right side of every asset account, other accounts are different. Every asset account, the credit side shows decreases to that account. So, for example, if I would go to, let's say, the office furniture account, in the ledger, there would be a page labeled office furniture. And if there's an amount of $500 on the debit side, that means I got some more office furniture. I must have purchased $500 worth of office furniture. Increases are shown on the debit side. Okay? Let's go back to cash. Again, increases to cash will be shown on the debit side. Decreases to cash, for example, if I spent money, my cash goes down. So somehow if I spent $50, that would end up showing on the credit side, the right side of the cash account. So you need to remember that in every single asset, no matter what kind of asset it is, however it's labeled, the debit side is the left side, and the debit side shows increases for assets. The credit side is the right side, it shows decreases. Now, to further complicate things, let's go to another tab at the bottom. These are all the liability accounts from this business. And again, these are things that we owe, taken from, again, the balance sheet. So, again, you see at the top, debit and credit. That never changes. That's the easy part. Debit always means left, no matter what kind of account you're talking about. Credit always means right, no matter what kind of account you're looking at. However, the increase side for any liability is the credit side. This is the side that shows increases. The debit side, the left side of any liability account, shows decreases. For example, if I buy something, my business buys something for $500 and we charge it, we owe more money. That $500 would somehow end up showing on the credit side of accounts payable because it increases what we owe. So if we pay back part of that money, that amount, whatever it is, would be ending up on the decrease side. It would be debited because it decreases the amount that we owe. So increases on the credit side, decreases on the debit side of every liability, whether it's mortgage, a loan, whatever the liability. Every left side is a debit side, every right side is a credit side, but for liabilities, increases are shown on the credit side, decreases on the debit side. Let's go to another one. Another kind of account, owner's equity. This shows the value of the business. This does look like liabilities. It's not a liability, but it looks like it's set up the same way. Debit means left, credit means right, and for owner's equity, the credit side excuse me, the credit side shows increases. The debit side shows decreases. So if our business is worth more money, whatever that value is would be increased and shown on the credit side. Again, you have to remember not only debit and credit side, but also which side shows increases, which side shows decreases, and you may need to go back and review this a few times. Two more kinds of accounts. These come from the income statement. The revenue account, this is money that we're earning. This comes into the business in form of sales. So that's an account. It has a left side debit, it has a right side credit, and for sales, for any revenue account, the credit side shows increases. So if we make more sales, let's say of $300, that $300 will be shown eventually on the credit side of sales, which indicates to us that we have made more sales. Okay? Debit side would show decreases. Okay? That would be a bit unusual, but assume we return money for somebody who brought merchandise back, for example. And we'll talk about that much later. But typically, most things on the revenue account would be shown on the increase side, the credit side. And finally, the last kind of account found in the ledger book, these skeletal accounts called T accounts represent all of the expenses from the income statement. These are expenses of the business, cost of doing business. And again, left is debit, right is credit, never changes. But again, every expense shows increases on the debit side, decreases on the credit side. So if we pay more rent, if we pay more advertising, if we pay for gas and oil, those amounts will be shown on the debit side of those expense accounts. Okay, rarely would there be a credit to an expense. We'll talk about exceptions later. But typically, expenses are debited because they increase. We have to pay. We got to pay the electric bill. That's shown on the debit side, the left side of this expense account. Now, all of this is new stuff, and we're looking at the ledger here, first of all, just to get you an idea of that important book of the business. These are, again, representing pages in the ledger, and when we look at an actual ledger, it'll be more detailed, showing more information than this. But this gives you the essence of each of the ledger pages. And these T accounts will always represent pages in that ledger. So you need to be able to know not only debit and credit side, but which side of expense accounts show increases, which side in revenue accounts, which side in owner's equity, liabilities, and assets. You need to know where the increase sides are and the decrease sides. And as I said earlier, it may be important for you to watch this video a couple times, maybe take notes, because this will be pretty basic fundamental information for, in fact, the rest of the course. You'll need to be very familiar with what kind of accounts these are and what side shows increases and what side shows decreases. So at this point, there is an assignment for you, so go back to your course page, please.